Hello, everybody. Welcome to my talk. I am talking about I thought I was done with stocks, but it's the chapter is, or part two of the book is risk and reward don't always go together. And the whole first part is of how risky the stock is. And, you know, it read a lot of like the history again that I talked about with the previous book, and this one has talked about it too, where before, we were in the growth time frame, and so it almost always went up, but still, had its ups and downs. And it says out of, I think it's since 1899, uh, it has gone down like a 40% of the time. Like every 10 years it dips, 40% of the time. Not every, but almost. Um, so that's mainly what they talk about, how it was growing, and a lot of people thought it could only go up, but then when they started seeing the downs, that and people lost a lot of things. It just says to be really smart of when you're gonna invest, because if you invest at the wrong time, you might lose it all. And opposed to that, when you invest at a good time, you might like skyrocket on your funds. But it's just really risky, and you have to know what you're doing, which is really crazy, because I read and I know I should be investing, because it also, both books say it's better to be investing even if you lose than not investing at all. That at least you're working your money, whereas if you have it in savings, it's just sitting there. So also says, they say that the younger you are, the more risk you could take. The older you are, it's harder to take risks, because there's some people, when they start seeing the stock decline, a lot of people take it out, like the 401k, all that stuff, and that's what makes it go down even worse, because people are scared, so they take their money. But there's people that wait and leave it, and know that it's gonna have a comeback, because all those people are gonna go back in once they feel safe. But it says that at different points, it's taken these people that stay in, that don't take their money out, stay in to make it go back up, that it takes them sometimes even 20 years to recover from the loss at this one point. And they just stay there and keep going. And I could also, in the book, they talk a lot about, because this is a book from you know uh, 1999, 2000. So they're talking about, and the other book I read too, it talks about it's been really nice for a while, so we're gonna see a decline come soon. And they were talking about what happened in 2007, 2008. And I remember that at that point, I was not knowledgeable, and I was not scared. I had my money in the 401k, because that's what the company recommends. So it was there. And then when that happened, I remember people coming in and just talking about how much they had lost from the 401k. And I had no idea what they were talking about. My money was there, and I had a lot of money, but I lost a lot of money too. But I had no idea how much money I had or how much money I lost. But in the other, turn of the tortilla, my dad was, he listens to the news all the time. So he was like watching and seeing how the money was declining, and he went into his 401k and took it all out, because my dad is 75 this year, So at that point, he said, That's like all my savings. Give it back to me." So he took all his money out, and whatever he had lost, he lost, and it's never coming back because he retired. He retired because of that. He lost his job like a lot of people did, and he was old enough. I think he was like 62, 63. So he decided, I'm done. And so he never put that money back into 401k or to invest it anywhere. So all the money that he lost at that point is lost forever. And the other side of the tortilla again, I had no idea that I lost money. I had no idea how much money I had. Like, that's how, like, not knowledgeable I was back then. I'm just starting to get a little knowledgeable now. But I didn't take it out. I didn't move it. I just left it there because I didn't know better. So it's been there, and I recouped all the money that I had lost at that point because it's been good up to now. Now it's like when COVID hit, then it declined again, but the stock hasn't been that bad till like just now. Like, we are in a bear market. Okay, bull market is when it's high, when you get all this money back, and bear market is when it's not doing good, when it's like the dough is going down, and that's where we're at right now. Like, last week was a bad week, but I still don't know what to do with my 401k, so it's just sitting there, just hopefully raising money for my retirement. But I just want to show you like the because it's talking about risk, and then there's this market decline from 1899 to 1990, and I I don't know if you could see it, but I don't understand it. But look at all those negatives right here in this line. That's from 1 year to the other. This is 1917. Oh, July 1690, and the low October 1190. But anyway, there's a like big decline. But that one I didn't understand because I just didn't. But this one right here, this is where it's performance of 10 desert island stocks in the 1973-1974 bear market. So it's like all companies that we know. I should change it this way so you can see it. I will. Okay. Give me a second. Because this I understood because I saw the high, and the high is high, and then the low, and then the decline is like 73%, 90%. That's a big decline. So let me turn this around to show you. So see those companies? Do you recognize American Express, Avon? Look, Avon went from selling at $140 a stock to $18.63 a stock, and that's in the 70s. So the decline was 86.7%, and you can see, like, I recognize all these, like Disney, Honeywell, Howard Johnson, Polaroid, RCA, Simplicity Pattern, I don't know who that is, Westinghouse, and Xerox. The only one I don't know is Simplicity Pattern. So these are like the big companies, and still they like go down a huge amount. But I thought that was neat to just kind of look at it and see where it's at. And then, I'm already at 10 minutes, and that's all I have. But I'm going to read. I didn't even write notes because it was all just, repetition from other things we've read. But points to remember. While stock have demonstrably proven to be superior investment vehicles long term, this does not alter their essential riskiness as speculative ventures. 2, there have been times throughout this epic American century of ours, some quite recent, when investors lost a considerable amount of money in the stock market because they were unwise enough or unlucky enough to have invested their assets in stocks at points of extreme market overhaul. 3. Not only can investors suffer large declines in the value of their portfolios, but those who have the psychological and financial stamina to sit out the recovery period have often had to wait as long as 25 or 30 years before retrieving their losses. That is what I was talking about. And number 4, it is important, indeed critical, to know when stocks are attractive investments relative to bonds in terms of valuation, and how to allocate assets in a way that will provide the maximum amount of returns with a minimum amount of risk over time. So chapter 6 is bonds can be risky too. So we're going to read for next Thursday about how bonds could be risky at times. So risky business. And just a little update on me. I this is my 6 months of review. I checked my stuff, and I am in debt, and that's why I'm doing this talk and reading investment books, so I could figure out a way to get out of debt by the time I'm 50. Well, that was a year, and this is my 6 month check, and I have gone down $10,000. So yay me. But I still have several to go, and if in half a year I did 10, then the other half I'm gonna do 10, and that's not even half of what I owe. And I want to be, if not completely financially independent by January of 2022, at least really close to it. So I decided, not listening to Your Money or Your Life, because the whole point of that first book that I read was to start minimizing the things you do and appreciating what you have, and stop working altogether and just live from the little bit of stuff you do. For example, my Beachbody that I enjoy working out, and now it's a little business where a little bit of money comes in, and I should be good with that little bit of money that comes in. But I can't get there until I am out of debt, because right now I'm still struggling, right? Even though I've gone down a substantial amount. But I decided to take on a second job. So I have my morning job, my hobby job, which is the Beachbody, and then I just grabbed a job last week working at a popsicle place, like a company that makes popsicles, and they let me bring some home to enjoy with my family. Anyway, I'm gonna do it the rest of this year, see if my strength lets me deal with it. Right now I'm my legs are tired, my back is tired, but it's all getting accustomed to it. It takes around a week, maybe 2, and then I'll be Fast and the Furious. But yes, that's where I'm at right now. I'm determined to go as low as I can before January 2022. That's when I turn 50. But I also have a lot of things coming up that would not be possible if I didn't have the second job, because of everything I owe. So I don't know. Decisions. Do I decide to have fun now or have fun later? The thing is, I don't have that much later, so I think I'll suffer these 6 months, see how much I could go down, and then maybe next year I'll be able to do the things I want while continuing to pay it down and just breathe a little easier. But for now, just that update and the risk factor of investing. And, if you're determined, you will do it. So, good luck to everybody. If you're listening to me and trying to follow in my footsteps, come on along. It's not that hard. You just have to have a goal and know that you're going to reach it no matter what. So I'll leave you with that. Subscribe. Listen to me some more. Adios, amigos.